Did you know Warren Buffett doesn't like dividends? Many people like to invest in dividend-paying stocks, but actually, that doesn't mean much. Paying dividends doesn't necessarily make a company a good investment. In this video, we will check out if dividends are really important in making an investment decision. When a company makes a profit, it can reinvest in its business, pay dividends, or repurchase shares. What do you prefer? To receive the money from earnings now through dividends, or that the company reinvests in its business with a 15% early return? Warren Buffett likes companies that can use their profits to reinvest in its business with a high return. Although you are not receiving the earnings from the company now, those investments can generate even more money in the long run, as it has the potential to increase the company's profit. In the 2012 Berkshire Hathaway annual letter, Buffett said, "A profitable company can allocate its earnings in various ways. A company's management should first examine reinvestment possibilities offered by its current business, projects to become more efficient, expand territorially, extend and improve product lines, or otherwise widen the economic moat separating the company from its competitors." So, if a company is able to reinvest its profit in its own business with a high return, it will probably be an amazing investment and will return more value than using this money to pay dividends. Sometimes it is not an option for a company to reinvest its earnings, as the company may be already too big, or there are no investment opportunities at that moment. When a company can't reinvest, it can choose between paying dividends or repurchasing shares. A share repurchase, or buyback, is a decision by the company to buy back its own shares from the marketplace. Because a share repurchase reduces the number of shares outstanding, it increases earnings per share, or EPS. A higher EPS elevates the market value of the remaining shares. When a company chooses to repurchase shares, it generates value to its investors, as you will own a larger part of the company's share. Let's say a company has 100 shares in the market, and you own 5 shares, which are 5% of all shares available. If the company repurchases 10 shares, now the total share available is 90, so now you own 5.55% of the company. That is how repurchase generates value to the shareholders. The big advantage of share repurchase over dividends is that the shareholder will not need to pay taxes like in dividends. That is why Warren Buffett likes companies that repurchase its shares. In the case of Berkshire Hathaway, Warren Buffett decided not to pay dividends and repurchase shares instead. Dividends are not bad, not at all, but when you are making an investment decision, the dividends are irrelevant. Would you not invest in a fantastic business that has several competitive advantages only because it does not pay dividends? When picking a stock, you should analyze if it is a good business with competitive advantages and if it has a good potential for the long run, and not whether it pays dividends or not. There are several companies that don't pay dividends that have an amazing return, like Amazon, Google, Berkshire Hathaway, Monster Beverage, and many others. When I say dividends are irrelevant, I don't mean they are bad. They only should not be a determining factor when you pick a stock. A company doesn't need to pay dividends to generate value. It can reinvest the earnings or repurchase shares, which will also generate value to its investor. My point is that paying dividends does not make a company a good or bad investment. There are good and bad companies that pay dividends. There are other factors that will show if a company is a good investment. So, it doesn't make sense to make an investment decision based only if the company pays or does not pay dividends. That is why dividends are irrelevant. In the book Common Stocks and Uncommon Profits, Philip Fisher says that people have some misunderstandings about the importance of dividends. He wrote, "It is possible that by spending earnings, not as dividends but to build a new plant, to launch a new product line, or to install some major cost-saving equipment in an old plant, the management might have been doing much more to benefit the stockholder than it would have been doing just by passing these earnings out as dividends." He argues that in general, an investor will always prefer a good company that can reinvest its profits in order to generate even more value. Many people don't get that if the company is retaining the earnings in order to invest, it can generate more value than passing these earnings out as dividends. Let's see an example. John has a store that is generating $100,000 of earnings per year. He can choose to get all this money now, or use it to open a new store that in the future will make the earnings $200,000. And after that, he can use the earnings of the two stores to open a new one and generate even more earnings in the future. That is a simple example of how a company can generate a lot of value without paying dividends. In the book Common Stocks and Uncommon Profits, Philip Fisher shows us what we have to look for when picking a stock. You can check out the top 5 lessons from this book by clicking on the card on the screen. If you like the video, please hit the like button and subscribe. Bye!